Hi guys, this is Erica from Gokche Capital. Now before I begin, be sure to click subscribe and turn on the notification bell. In 2020, the building housing McDonald's Chicago headquarters sold for $412 million. But the building was really only worth $148 million. So how did this happen? We'll let you know at the end of this video. But first, if you want to know whether a real estate acquisition is a good investment, you should understand how to calculate a purchase's cap rate and return on investment. And in today's video, we have an overview of these two metrics. Number 1, what is the cap rate? A cap rate, or capitalization rate, is a financial metric used by investors to calculate the rate of return from an investment. It is the net operating income of a property divided by the property's value or sales price. Number 2, what information does the cap rate provide? First of all, it can tell you something about your potential return if you are purchasing a property with cash. A higher cap rate means that an investor is achieving a higher return. That said, this also means that the buyer is taking on more risk. A higher cap rate means that the market sees more risk and demands higher returns. In addition, the cap rate can be used to try to calculate a property's market value or to estimate the potential sales price. Number 3, let's look at an example of how you can use a cap rate to estimate market value. Let's say you own a commercial property in a market where the average cap rate is 7%. Your property's net operating income is $87,500. You can estimate the property's current value by dividing the net operating income by the average cap rate to achieve a valuation of $1.25 million. Number 4, what is a good cap rate? As with any financial metric, it depends on the investor. What is considered a good cap rate varies based on the following. Location. You may often hear it said that a range of 8 to 12% is considered a good cap rate. Yet in many high-demand, high-cost areas like New York City or Los Angeles, you'll see that a cap rate around 4% may be normal. Your risk tolerance as an investor also makes a big difference when it comes to the cap rate. Some investors are looking for a passive and stable investment. Others are willing to take on a higher risk in exchange for higher rewards. These investors will be looking for a higher cap rate. It's also important to take into consideration planned improvements. After you buy a property, if you intend to renovate it, you may find that you are able to increase your rents and/or decrease your vacancy rate. This will change your net operating income and will have a big effect on your overall cap rate. Number 5, what is the ROI? ROI stands for return on investment. It is your annual cash return divided by the total cash you invested. This is a very simple metric and one of the easiest ways to assess an investment return. Number 6, what information does the ROI provide? Essentially, the ROI is the annual return on your investment. Number 7, let's look at an example. Let's say you are investing $18,000 in a single-family rental. The projected annual net income from the rental is $2,400. You divide the annual net income by the amount of money you are investing to get an ROI of 13.3%. Number 8, what is a good ROI? As with the cap rate, it depends on how aggressive you wish to be with your investment, as well as your risk tolerance. And finally, number 9, which is the better metric to use when trying to analyze a potential purchase? Well, the short answer is you want to use both because they analyze different things. The cap rate is tied to the value of the real estate. The cap rate shows the property's worth in comparison with the rental income it generates. It also helps compare both the potential return and potential risk of similar properties in the same neighborhood. On the other hand, the ROI is tied to your personal return based on the money you've invested. For the same investment property, there can be different ROIs depending on the financing method. So as we said, at the end of the day, you want to look at both. Taken together, these, along with other metrics, can help you analyze whether a potential investment makes sense. But now that we've covered cap rate and ROI, let's return to the overpriced McDonald's headquarters. In 2020, McDonald's Chicago headquarters sold for almost 3 times its most recent appraised value. And it was not the only building in town to do so. A few blocks north, Google's Midwest headquarters sold for $355 million. But the latest appraisal valued it at just $135 million. So what's going on in Chicago? Well, commercial appraisers use multiple assumptions when they craft their appraised value of a property. And all of these assumptions can be tweaked to push the appraised value down when a property owner appeals a tax assessment. In the case of the McDonald's headquarters building, the property owners filed an appeal to a 2021 increase in the property's assessed value. In this appeal, the property owner supplied an appraisal that showed a valuation of just $148.7 million. This despite the fact that the property sold in 2020, just a year earlier, for $412.5 million. So how did the appraiser justify this valuation? They played with the cap rate, of course. The appraisal used to justify the property owner's appeal assumed a 7% base cap rate. Yet cap rates for recent commercial sales in the same area fell closer to the 5 to 6% range. And as the cap rate goes up, the market value goes down. On top of this, the appraiser also lowered the assumed market rent, arguing that the recent COVID pandemic had devastated the local office market. Taken together, these two assumptions lowered the potential appraised value by nearly $100 million, which just goes to show it is important to thoroughly review both your own and others' assumptions when analyzing cap rates and other financial metrics. But wait a minute, you may be thinking, how come the assessor didn't catch such blatant machinations? Well, appraisers do have a wide latitude when it comes to appeals. Still, the Cook County assessor has asked the Illinois Department of Financial and Professional Regulation to investigate appraisers that may have violated professional standards. However, we will have to wait and see what happens to assessed values in the upcoming years. But what do you think? Do you have any stories about cap rates, financial metrics, or appraised values? Let us know in the comments. Did you like this video? You're going to love our Gokce Land Due Diligence program. We'll make you a land due diligence expert in just 7 days. Check it out at gokcecapital.com/glad. And while you're at our website, don't forget to explore our $1 down listings at gokcecapital.com/listings. Finally, don't hesitate to reach out. You can email, call, or text, and we will respond as soon as possible. So thank you for listening, and more to come.